Thanks for tuning in. You got the backstage passes here before we actually get started, but thank you for joining us. We'll give people some time to get signed in here. Certainly appreciate your support and appreciate you taking the time to either watch this live or watch it as a replay.
Indeed, and as always, as people are coming in, we'll give some reminders that please use that Q&A feature down at the bottom of your screen. If you do have any questions along the way, we'll save some time for at the end there, or try to tackle them as we can.
We do. We love questions. So yeah, keep them coming. Definitely makes it fun for us to interact with you. If you're watching this after the fact, you can always shoot us an email. We're always happy to hop on a call with you as well, but definitely appreciate those of you who've jumped in here live.
Absolutely.
Lots of people getting signed in. I think we have a record actually from the pre-registrations that we've seen. This is actually a record for us. So we actually have far more people watch it as a replay afterwards. I think that's normal on our YouTube channel, but I certainly appreciate those of you who have carved out the time today to spend with us on Valentine's Day.
Valentine's
Day. Right.
I don't think we've ever done a forecast on Valentine's.
We never have.
Valentine's.
This is a first. Yeah.
We will be sticking to financial topics, though, not topics of love life.
Yeah, exactly. Yeah.
Forecasting. Good stuff. Well, yes, everybody is coming in. We have about 11:28 right now, so we give you a couple more minutes, but we will start promptly at 11:30.
We do love our clients.
And we do love our clients.
We love our team. So thank you. Yeah. Thanks for giving us some of your Valentine's Day that we get to spend with you, right?
That's right.
Yeah, this is fun for us. And yeah, certainly an opportunity for us to be able to visit with you live, and also for those of you who are watching the recording. Again, before we get started, one thing to note is that we do like questions, and we'll monitor the chat. So if you see us looking up, we're looking at our chat screens and want to be able to respond to folks who are asking.
So we have someone saying the video feed is at the bottom of my screen. I think for Zoom, typically you can grab it and drag it wherever you want it. Mm-hmm. So try that out.
Yeah, or maximize the window. Sometimes if you go to the upper right-hand corner, you can maximize your window and it'll pop up.
Yes, indeed. Good. Very good turnout today.
Yeah. Yeah, welcome everybody.
Yep, and again, we will say that trying to do some technical consultation here before we get started.
Yeah, if anybody can give us additional feedback. We've gotten a couple of people saying that they weren't able to see the screen. Can everybody see us? If you can throw that into the chat.
Okay.
Make sure that it's not we want to make sure that it's not a global issue, that maybe it's just a couple of folks. All right, good. Okay. We've gotten some responses in. Thank you.
Good deal. Good deal. Very good. Well, it is 11:30.
11:30 Mountain Time.
So I do believe that is about time. Yep. So we do have a chat up there. Question and answer is probably the better place to go, just because that kind of keeps a good record of it, and we can see them come in as they go. So please use that. But we will go ahead and get started here.
All right. Sounds good. Are we recording?
We are recording.
All right. Welcome, everybody, to the Keystone Financial Services Studios. It's Josh and Jeremy here, your certified financial planners. And that's important because that is the gold standard when it comes to our industry. You want to make sure that you're working with a CFP. That's kind of critical because that means that you're working with a fiduciary by law. Actually, we can't call ourselves a CFP unless we also call ourselves a fiduciary. That means that we're working in your best interest. We're giving you advice that's in your best interest. So certainly want to make sure that you've got that. You've got two here. You've got two of us that you get to work with. And certainly we enjoy the education part of things too, actually. So this is actually one of our favorite things, to jump on here and interact with you, answer questions, and also give some perspective on where we've been and where we think we might be going this year.
Absolutely. Yes, always a pleasure. And then, of course, being CFPs, we cover a number of different topics, right? So, it's not just your investments that we're looking at. We're looking at cash flows. We're looking at tax planning, really a little bit of everything. And so we know that it all kind of plays together, obviously. So
yeah, absolutely.
It's all important to look at.
Yeah, I kind of think of it like we're holistic medicine doctors, right? Where we're kind of looking at everything instead of just prescribing pills, right? We can also say, hey, we need some chiropractic or something else that might fix the job. But really looking at all these different areas, tax planning, estate planning, these things all interact, and they're all areas of your financial life, not just the investments. So definitely want to be able to help you with anything that you need. That is what differentiates us, though, is we're holistic, we're comprehensive, not just talking about products. And the vast majority of the time, that's the experience we get, is when people come to us and maybe they've worked with another advisor. They might have been working with a broker, actually, somebody who was selling products. Doesn't mean they're a bad person, but there's just a different level of sophistication and a different level of motivation too, as far as kind of the recommendations that you're getting.
Absolutely. And of course, our good old disclosures. So really, this is obviously, we're not going to guarantee anything. This is our opinions at this point, but important to get it out there.
Yep, the attorneys say that we should say that, and it's true as well, right? But these are just our opinions today, and I think you'll enjoy the presentation. But just know that even the experts, and I think that's really one thing that we can say pretty consistently, is the experts. In other words, the people that are on the Federal Reserve Board, the people that are managing the biggest portfolios, even they don't know. So if you haven't predicted the future in the past, neither can they. That should make you feel a lot better about all of this.
Absolutely. All right. So really, where do we go from here? 2023 in review. We'll take a look at what happened in 2023.
Yeah, I think it was a good year.
Absolutely. If we would this time last year, I think we were thinking probably some different things.
We were, for sure.
Just goes to show you can never really tell.
Yeah. In fact, I was at a financial conference exactly a year ago right now. And they're normally, a lot of the speakers, typically there'll be 6, 7, 8 of them will be billionaires, right? People that are managing the biggest hedge funds and private equity funds. People that have been in really high positions in government, both in the U.S. and abroad. And most of them were extremely pessimistic a year ago. In other words, very pessimistic on the market, the economy. There was not a forecast for very good numbers, yet we ended up having one of the best stock market years ever. So yeah, it's pretty important, I think, to recognize that even people with all the information seemingly can't predict the future.
Absolutely. Doesn't want to play nice.
It doesn't want to play nice.
Go figure. No. All right. We'll do this.
Sam Bankman-Fried. I think he's been out of the news for a while. I think because he's in prison, right?
Yeah, he is. Yes.
So yeah, we're not hearing much from him these days. But that was the kind of the news a year ago. Right now is the FTX, major cryptocurrency exchange. Actually, there was a lot of fraud, a lot of really inappropriate stuff that was going on there. A lot of money was lost. And for a while there, we didn't hear a lot about cryptocurrency at all, right? It really put a damper on that market. So that was definitely what was being talked about a year ago. And certainly the stock market, really defied expectations.
It really did. And it's not like crypto is gone. I mean, now fairly recently, honestly, Fidelity, Vanguard, a lot of these major brokerages have come out with their own crypto exchange traded funds.
Yeah, that was a big deal. It basically kind of opens things up to the public versus it was kind of, and not to say that you can't go directly to a crypto exchange now. And believe me, we're not recommending you go out and invest in cryptocurrency, but it is a thing, right? It's certainly something that you're hearing about. You're probably hearing friends talk about it. Basically, having funds that you can buy now, it makes it a lot easier for people in their accounts, in their 401ks, things like that. Again, not necessarily what we would recommend because it's extremely high risk.
Absolutely.
Right? And really, when you're buying cryptocurrency, all you're buying the hope that somebody else comes along and buys it for more than you did. Right? It strictly is a commodity. and one that actually at this point, at least, it's not useful for anything. It's not like oil or corn or something like that, that's actually a commodity that has some utility.
Yeah, but really, I think the whole purpose of this one right here is you can see the little thing on the bottom, the next Warren Buffett.
Yeah.
Not quite.
Mm-hmm.
So, it's funny how fast things can change. And
yeah.
going into 2023, we were really thinking, this is going to be probably a rough year,
Mm-hmm.
right? Not a lot that we're expecting out of it. But then in hindsight, we look at it and the S&P 500 was up over 20%.
Yeah, and I think that just underscores why we don't try to time the market. Because if we try to time the market, even Warren Buffett, some of the most successful investors of all time have said they don't know how to time the market either. So we probably shouldn't try that either, right? If we had done that a year ago, that would have been not so good. You probably would have been sitting in cash, right? And missed out on a really good stock market year. So that's a lot of really what the advantage of working with a fiduciary is. We can help take the emotions out of things, though, and think more strategically, right, as far as how the long-term successful investors behave.
Absolutely. But as we know, 2024 is an election year.
Yes, sure. None of you heard that before, right?
No,
there's a presidential election this year.
I don't know about you. I've been in the client review meetings that I have been having. I have been getting that question a lot. What to expect? It's an election year. What kind of things should we be looking at? Is it typically bad or not? But if we look at the past history, so all the history that we've had, I think this goes at least back to 1950 or so, right? Of the various years of a presidency. So right now we're on that far right one there, that year 4. And if it's a re-elected president or a new president, the average year is about 7%.
Yeah, for presidential election.
Right.
And I think most of us would be happy with that, actually, if that was the end result this year.
Absolutely. Absolutely. So you can see year 3 is pretty good. The numbers are kind of all over the place. Really, historically, the worst year is year 2. But an average year 4 of 7. And then honestly, year 1 is pretty decent year 2.
Yeah. It's kind of interesting that has played out. Right. Not that this guarantees anything or that you should try to time the market based off of this. But if you think about Biden's presidency, market did okay in 2021, not so good in 22, really good in 23, year 3 again. So this year, we're expecting that, at least if history is our guide, that it should be an okay year. Right?
Yeah, absolutely.
Looking at year 1, of course, next year, we'll do a forecast next year as well. But looking at year one actually ends up being a good year. And that's, I think, a lot of the questions we're getting is, gosh, what if Biden wins? What if Trump wins? Right? Are things going to blow up? And, we don't know that. Right. But as far as using history as our guide, year 1 of either a re-elected president or a new president actually ends up being a pretty decent year.
And of course, if we look on a long enough time frame, the market really doesn't care.
Right. Yeah, exactly. Yeah.
It just doesn't. The market's going to do what it does.
It does. And, the thing is with politics, again, this is on a lot of people's minds right now. It's not that it doesn't matter. Certainly, there's a lot of personal, feelings around, people's views and so forth. And not to say that policy doesn't affect the economy, either help it or hurt it. But at the end of the day, you think about the stock market, the economy is really just made up of consumers and businesses for the most part. And regardless of what the outcome is, people are going to kind of figure it out and move on. That includes us as consumers. Tax rates go up, they go down, they go sideways. We'll adapt to it, right? It's something that, everything's not going to just shut down because of one president or another.
Absolutely.
So, lots of volatility, though. There could be a lot of swings in the market.
Never fails. Right. Never fails. But as it sits right now, bull market is still alive and well. Obviously, we had kind of a big bump yesterday. Down. Bump down. That's probably not a good term, but in reality, I think it's just that's the reality that we live in.
And profit margins ultimately, the day-to-day, it's going to be the news, it's going to be geopolitical stuff, it's going to be whatever shock events are going on. That is what's going to swing prices on a day-to-day basis. But over the long run, it really does come down to earnings, company profits, in other words. And actually, margins have been getting better. Ultimately, that's what's going to make stock prices go up over time. A company really is just worth its earnings, right? There's real estate and property, plant and equipment, things like that. But ultimately, most of the value of a company is really its earnings. So because we're experiencing earnings growth by and large, not every sector, but certainly earnings growth is definitely a good thing in the equation as far as expecting stock prices to go up.
Absolutely. And so it really does play in too, because I think a lot of, so yesterday, the Fed came out and said, hey, inflation didn't drop as far as we thought it was going to. It did still drop overall, but it was, I think, 0.01% off from what they were expecting, which sent the market into a bit of a tizzy for a day, right?
Yeah.
But still, the things that are driving it is, like you said, it's the earnings, right? It's the earnings potential for a lot of that stuff, and it is skewed, obviously, depending on what it is. But as far as sectors go, but that's nothing new either, right?
No. So yeah, I think profit margins increasing, that should help stock prices. That's definitely something that makes us feel good.
Yeah. Of course, the thing to remember is that we always talk about average years, right? Average years in the market, and 9% as an average. But yeah, how often do we actually hit that average?
Right. And that's kind of averaging out the S&P 500, right, over a lot of years back to 1950.
Yeah.
And you can look at different time periods. Sometimes it'll be higher than 9, sometimes lower than 9. But there's only been 4 times that it's actually even gotten anywhere close to 9 over the last 70 years or so, 73 years. So yeah, it's something just to keep in mind, that the swings that you're seeing in your returns, nobody likes to see a down statement, right? That's just the reality. Nobody likes to log into their account or see their statement and see a negative number. So it is challenging during years like 2022, when the stock market, the bond market, the cryptocurrency market, the real estate market, kind of everything was down that year. So it didn't seem to matter how diversified you were still seeing negative numbers in your statements. That's exactly why it's so hard for people to get good results over time, is because left to people's own emotions. And Fidelity has actually done studies on this, believe it or not. Fidelity has done studies. They've got trillions of dollars, literally, between all the retirement plans and people's accounts. And what they found is that there's a category of people that tend to do the best, actually, if they look at all the accounts. And Jeremy, it's actually dead people.
I guess dead people don't trade.
Dead people do not trade.
They also don't get very emotional about swings in the market.
They do not. And, it's obviously tongue in cheek, but they really did do that study and found that the best performance were people that weren't going in, logging into their account all the time, trading all the time. Although I think it's just human nature that we want to feel like we have control, right? And feel like there's something that we can do that will result in better results. But most of the time, the discipline of sticking with an investment strategy, doing disciplined rebalancing, making sure that we've got lots of different asset classes covered, although that seems really boring, right? And it seems like, gosh, there must be some way that you can trick the market. It doesn't tend to work. So use Fidelity study maybe as something to think about next time that you're tempted, even if it's a friend or something like that, telling you, oh yeah, you should go buy a Bitcoin or something like that. Maybe think about that sometimes the best thing is actually to do nothing.
Absolutely. So again, if this time last year, I know we had talked about signs of recession, right? And what they were saying, and I think this time last year, we were both kind of in the same bin, saying, yeah, good possibility. Right.
Yeah. But soft landing is why, the Fed was kind of calling for a soft landing. And it seems like so far at least, there could be a shock event or something like that. It seems like they might actually get it right. And Jerome Powell, the Federal Reserve Chairman, actually, this is the last year, unless he gets reappointed next year. Not likely, actually. I think Trump has already said that he wouldn't reappoint him. Biden actually wasn't going to appoint him in the first place. He wasn't going to reappoint him. So they're saying that it's pretty likely that he's just going to retire. He's not really going to try to go for another term. And really, the reality is I think he wants to go out at this point, having slayed the inflation dragon. And it seems like that's actually happening. Never mind the fact that they actually created the inflation problem to begin with, right back in after the pandemic, injecting trillions and trillions of dollars into the economy, right? That actually created an inflation problem. But it seems that they've actually gotten it right so far as getting inflation to come back down.
Which I think we're both kind of surprised at, right? I think you can look over the last 100 years, and soft landing by the Fed has been done maybe 5 times.
Yeah.
Over the last 100 years. So this will chalk up number 6. It's fairly impressive. It's not easy to do either.
Right. So that's one thing that we should be aware of, although we're hoping for some rate decreases this year. That's kind of what the market is baking in, is that we could see one or more interest rate decreases. So far, the Federal Reserve has been much more concerned about inflation and making sure that it really is going down. What happened historically is back in the early 80s, they thought they had kind of slayed the inflation dragon. The Fed started lowering rates, and inflation took back off again. They had to come back and fight it again. So that's one thing that we should be aware of, at least, is that they don't want a repeat of that, and especially if this is his last year, he doesn't want to go down in history as being having not done the job, right, not gotten it done. So definitely a lot of people watching the Federal Reserve, watching what they're saying, what indications of the numbers, of inflation numbers, as far as where things might go.
Yeah, and there's and when we do look at inflation and the things that play into it, so obviously labor market is a big part of that.
Huge,
right?
Yeah.
And honestly, right now, labor market is still very, very strong. We're at what, about 3.5%?
Yeah, yep. Historically, at a 60-year low, something like that right now, which we've been at. There was a spike certainly back in 2020. A lot of layoffs happened, but really most of those jobs have been recouped. There are some indications, if you really drill down into the data, that there may be a lot of people that are underemployed. So that's a reality, right? There may be a lot of people that aren't working full time, that they wouldn't technically be considered unemployed, but they might be underemployed. So a lot of dynamics happening right now. The other thing is that we're still, and we talked about this for years, right? That we're still in this period of time where we've got 10,000 people a day in America, 10,000 baby boomers, in other words, a day, that are hitting age 65. That's a lot of people. And for many of our clients, at least, not all, but many of our clients, that's kind of their trigger for retirement, where they say, you know what, I qualify for Medicare now, and kind of coming up on Social Security eligibility for full benefits. A lot of people kind of use that as their opportunity to leave the workforce. So again, some of this is because of the pandemic, just lagging effects, but it's also that a lot of people are leaving full-time positions, and maybe those positions are being replaced by part-timers.
Absolutely. We had a quick question from George.
Yeah, good.
Looking at the right-hand side of this slide, as far as what this is telling us. So American households are better positioned financially. So, okay. So really, George, what that's looking at is it's looking at kind of the breakdown between American assets and where they are. And so during this time period on the far right, basically, we've been kind of pushing that way. All the red, it's kind of even small for us to see right there.
Yeah, see, we're getting old.
Right. I need some readers.
Now, yeah, Jeremy and I are going to have to go get our eyes checked. But yeah, the household budgets have been improving, though. Certainly, consumers are in a pretty good shape. There's some indications that people are taking on some extra debt, as inflation has ticked up. But by and large, people have money, they're still spending it.
Yep. And so really the red part at the bottom is it's just saying kind of percentage as a whole of what everything. So the red would be kind of liabilities. Blue and the green kind of gets into the assets a little bit more. So I think, and a lot of this stems from a big chunk of the cash that we had initially all got from, during 2022, during COVID, or during COVID.
And they say that's recently been spent, essentially.
Yep. And so a lot of that has been spent down. There are shifts in this, but really it's a percentage scale, basically just means percent of total. So what percent are each of these categories taking into account on their overall net worth, basically?
And no surprise, really, over the last year, people's home equity, for most people, home equity is still there, and most areas of the country haven't seen a massive drop off in housing prices. And then, of course, people's accounts, their stock accounts, their bond accounts, pretty much all asset classes went up last year. So that definitely has helped.
Yeah. And again, kind of going back to that other one, why? Because, anybody who wants to be employed is gainfully employed. Right.
Yeah.
Which does also factor into kind of that overarching inflation thing. So yes, inflation has been ticking down. The Fed has done a lot to bring rates up. I think really again, when we look at something that happened like yesterday, where they say, well, we missed our inflation mark by 0.01%,
right?
That's how closely everybody's watching the Fed. And
yeah,
I think right now what we're seeing is that a lot of the good news and the expectations of rate drops coming this year are really kind of built into the market already, right?
Yep, they are.
Yeah.
So it could be especially sensitive. The market doesn't like surprises.
Exactly.
Right. So especially if that tended to be more of a trend, let's say we get a number of inflation reports where they're higher than expected, then that could really put a damper on those rate cuts that the market's counting on, right?
Absolutely. Which I think is what kind of that explains yesterday, right? Is they said, oh, that might mean that they're going to hold off on rate cuts, right? But
consumers are pretty resilient, though. I mean, as we've been kind of going through these slides, consumers have been resilient, and I think the categories, if you really parse out the data, the categories where people are spending their money has changed somewhat. But I mean, you go out any place, right? Try to go to a concert, go to the airport. People are doing stuff. I mean, people have money.
Yeah.
The good news too, I think, is that it's actually our money now, right? As opposed to it being that government money. So, really the last few years, a lot of it as well, it's pandemic money, it's stimulus money and so forth. That money's pretty much gone at this point, kind of by and large. So this actually is, people that really have discretionary income that are spending it.
Yeah. And really kind of the unfair thing, or another thing that I think I hear a lot in is, so we hear all these things about inflation coming down, but why doesn't it feel like it when I go to the grocery store?
Right. And that's one area
which
that
is
has spiked.
real.
Yes, that's a huge spike.
So and so that's the thing about inflation too, is that it doesn't hit everywhere at the same time.
Yeah.
Right. And as you go through kind of the cycle of inflation and then deflation, and just everything has that cycle, but there are things that kind of hold on more. So the places where we still feel it and see it right now, of course, the biggest players are food prices and housing.
Right. Yeah, those two areas are still very expensive. There's other areas that, like fuel prices, some have come down substantially from where natural gas prices before were much higher than they are. So then that actually, and that's a big deal as well, kind of energy prices, because that acts like a tax on us all individually, on companies. You figure everybody needs fossil fuels largely right now. Most of the world is operating off of fossil fuels. That's getting more diversified over time with alternative energy, but that's a long-term story, right? The world by and large, is operating just off of fossil fuels. So massive difference. And certainly the labor market as well makes a big difference with inflation. When it's tight, then there are more pay increases, benefit increases, things like that are expected from employers. And of course, companies don't like to just absorb costs, right? They will pass that increase on to consumers, which can cause inflation. That's where all this is interrelated.
Yeah, absolutely. And actually, we got a pretty good question up here. I like this. Is it fair to assume the high prices are also caused by corporate greed? Yeah,
okay, you could use that term. But yeah, like I just said, with profit margins, companies don't like making less money. So if their costs are going up, it's going to get passed on to the consumers.
Absolutely. Yeah, it does. And
so we all pay for it, in other words.
Yeah. And that's the thing about inflation, especially in things like food prices, right? Is they'll crank it up whenever it starts to hurt their pocketbook, but they're pretty slow to start taking it back down again.
They are. Yeah, and there's just the price of eggs and bacon and things like that. Prices, they have come down, but slower than when they went up.
Absolutely.
So, it's definitely interesting to see that, or the packaging too. That's probably something you all have noticed as well, is the portion size at restaurants, packaging size, where they'll keep the price the same, but they'll lower the quantity of what you get. So as a consumer, you got to be savvy. You got to watch out. They'll get you.
Absolutely. Yeah. Well, and kind of another question I keep getting too is, why isn't it falling faster? Right? Why isn't it falling faster? But when you think about it, 70% of our economy, we've said this time and time again, is the fact that 70% of our economy is people like you and me spending money. Right. And
absolutely.
The fact is that incomes are strong and people are still spending money. Right.
Yep. And the rest of it is government and business spending. But by and large, and we hear a lot about government debt and things like that. Not to say that those aren't concerns, but by and large, so much of this comes down to just people having money. So that's why that unemployment rate is so huge, right? but also employment too. Wondering how much of the population actually wants a job, and as those 10,000 people a day are retiring, well, they don't want a job anymore.
Right.
So it's something that we're contending with. Other parts of the world are as well, certainly. But as we've got an aging workforce, it certainly makes a difference. So some of that, in the United States at least, we've kind of solved that problem in the past, and I think we will in the future with technology. Really, that continues to be, and a lot of our clients came from the tech sector, right? So, and it's still in the tech sector. So, we're working on solutions that. Whether it's robotics or AI, quantum computing, there's lots of things kind of coming together that will fill a lot of that gap.
Absolutely.
Yeah.
Absolutely. Yep. Then we had another one from the gallery: earnings pressure from Wall Street drives corporate greed.
Yeah. Absolutely.
Yeah. That's, the market there's always that pressure to meet those earnings estimates, right? When companies don't meet those earnings estimates, it has that negative effect.
Yeah. So. Yeah. That's how they're being held accountable by shareholders, and to a large degree, even they've got a fiduciary responsibility. So not to like defend, corporate greed or something like that, but ultimately, their motivation is that, ultimately, we hope they also at the same time want to take care of their employees and customers and be good stewards of all of that. But they definitely can't take the eye off of that profit ball.
Absolutely.
Yeah.
And then, of course, one of our favorite guys to listen to, Mr. Warren Buffett. I love this quote here: "Stock market is a device for transferring money from the impatient to the patient."
Yeah, we kind of talked about that before. Other Fidelity studies they've done actually on 401k activity, because they're kind of the 800-pound gorilla in the 401k space. So they've got a lot of this data as far as people's real rates of return. And the average investor doesn't do very well as far as their real results. And it's not because they pick bad investments. It's because of the investor, right? The investor's behavior and tending to want to buy when prices are high, and then they want to sell when prices are low. And you might all be listening to this and saying, well, that doesn't make sense. Why would you do that? Are you supposed to buy low and sell high? Yes, that's true. But most people don't. And that's why their results are so poor. That's one thing. And Vanguard's done studies on this too, actually, that in and of itself can result in much higher rates of return by working with a good fiduciary, a good financial planner that will help you stay disciplined and not get sucked into that cycle of wanting to buy Bitcoin now that it's 50,000. Well, why would you do that? You could have bought it when it was 15,000, right, at the low, but nobody wants to, right, because it doesn't feel good at that point.
And that's the thing is, hiring a professional, I think you get that kind of emotional disconnect, right? As I don't know about you, but obviously we want to do right by our clients. We have that legal obligation to do what's in their best interest, and a lot of the time, your best interest is not necessarily what your emotions are telling you to do in the moment.
Absolutely. Yeah. Yep. And Buffett's, he's got a lot of great quotes about that over the years, but one of the most successful investors of the last 70 years or so.
Absolutely.
And he still says he's never met anybody that has been able to time the market consistently. Get lucky once in a while, absolutely. But to do it over decades, no.
Yep, absolutely. So then, of course, what does it mean? What are we kind of looking at as far as rate cuts?
Yeah, rate cuts. So I was just at the financial conference last week. I think there were 8 billionaires that were speaking, including Ray Dalio, who is still the largest hedge fund in the world, Bridgewater Capital. So not that any of these people can guarantee anything, because last year they didn't either, right? But yeah, overall, their expectation is that there'll be 1 to 3 quarter point rate cuts this year, 1 to 3, and a lot of that, I think, some people are hoping that it would be more than that the Fed would get really aggressive, and it's possible if there's a shock event. That's a little bit different. If there was some kind of a, I hate to even say it, right, but like a 9/11 or another pandemic or something like that, then all bets are off, right? Things are going to be very different. All the central banks across the world will get very aggressive about lowering rates. But if we are kind of plodding along like we think we're going to with the data that's out there, probably 1 to 3 rate cuts this year. It is possible that the one in March won't happen. There was a hope at one point that there would have been a rate cut. But with the inflation report yesterday, that puts those odds down a little bit further. Again, kind of looking at the motivation of Jerome Powell himself, motivation is definitely more on keeping prices steady and making sure that inflation doesn't go crazy again. So, yeah. And overall, the consumer has been pretty resilient, even with these higher rates. And certainly there are sectors of the economy that have gotten hurt with higher rates, but the consumers are still pretty, we're all spending money, right? Most people still have jobs. There haven't been massive layoffs really across the board. So overall, yeah, things are still looking pretty good for maybe a 1 to 3 rate cut. I wouldn't get real excited. This is a trend that's going to be over years, not over just a couple of quarters, that rates should be falling.
That's a really good point, because if we look at history and how the Fed typically works, they're very, very quick to raise that rate, right? They'll do it by leaps and bounds, but bringing it back down is like going down an escalator. Right. It's very slow, very methodic.
Again, the only time we see it happen fast is like after a 9/11 or the financial crisis in 08, or the pandemic, these big shock events, right, that happen from time to time. That's unfortunately, that's just part of life. These things happen and they're not predictable. Most of them are not predictable. So that's why the Fed really throws gas on the fire. We think, that they probably threw too much gas on the fire, and that's why it created the inflation problem to begin with. So yeah, it's really interesting. All of this not predictable, but that's our best guess.
Absolutely. We have another good question, actually. Is with the Magnificent Seven making up about 30% of the S&P 500 market cap and sitting at PE ratios around 35, are you long or short on these companies looking into 2024?
Yeah, so we typically don't short anything, in the market. That's a dangerous game. But I think it's a good perspective as far as why, not just put all your money in the S&P 500 and call it a day. There's a lot of risk there, right? There's a lot of risk because you're concentrated among a fairly small number of companies. And because a lot of them are trading at such high multiples right now, they need some really strong growth. And maybe we'll still see it, right? It's possible that'll happen. But there's a lot of downside risk that could happen if you're overly exposed to just that one area.
Absolutely. And so really, we have a pretty diversified crew of clients here. And that was a fairly technical question.
It was.
So to kind of rephrase that so that everybody's kind of on the same page, right, is when we talk about the Magnificent Seven, there's the large portion of what happened in the S&P 500 last year was really driven by very few companies.
And basically companies, they had a lot of artificial intelligence, AI, right? That's the buzzword these days.
A lot of that. And so, are they fairly priced? Do we see them kind of taking a step back because they're up there? So really what we've seen, to kind of also additionally answer your question there, is 2023 was largely just a few companies, but we've actually seen that spread out, especially over the last couple months specifically. So yay for 2023, and they did a good job in that. But when we're talking about kind of companies that big, those Magnificent Seven, those are companies that pretty regularly do some pretty incredible things as far as earnings and what goes. So I think overall what we're seeing is, and if you take anything away from this, is we'll probably see 2024, what we can see right now is going to be probably more muted than 2023, right? And things spread out a lot more. Does that mean go ahead and sell those companies that did really great? Probably not. But maybe stay diversified, because that's really what we can kind of see at this point.
And there are certainly opportunities where we rebalance. I think that's part of being a good, prudent investor, is rebalancing. And if you have had some of those companies that have really taken off and seen huge gains, we've been doing some of that, trimming some of those gains off and reinvesting it back into the more diversified part of the portfolio. So we always want to make sure we're invested in lots of different stuff, having lots of different asset classes covered and lots of different individual companies. But it's a good identification. And certainly in the late 90s, when I started as an advisor in the industry, there's some parallels, right, that the market was fairly expensive right then. But it also tells you that if you've got exposure to the rest of the market, not just AMD and NVIDIA and some of these really high-flying stocks from last year, if you're diversified, there's still a lot of opportunities, actually. A lot of companies that are not terribly overpriced.
There's a reason those companies got to be that big in the first place, right? Because they're really good at what they do.
And that trend probably is going to continue. I mean, realistically, a lot of the advancement that's going to happen, and we don't even understand. Nobody really does at this point, as far as the the risks. I mean, kind of some of the downsides of artificial intelligence, but certainly there will be good things that come from it as well, just like the internet, right? Just from smartphones, everything that we're using right now and take for granted. There were also people that were worried about that stuff, and it turned out that there were positives and negatives, but by and large, things that we just take for granted and have resulted in a lot of productivity.
Not every AI scenario leads to Terminator,
right? Yeah, exactly.
Skynet.
Yeah,
absolutely. Right. So eventually, yes, the Fed will lower rates, right? When is anybody's guess.
Yeah, probably not next month. I think that's a little bit less likely at this point, but yeah, again, 1 to 3, probably 1 to 3 rate cuts this year. Barry Habib was also one of the speakers. He's the top mortgage rate forecaster in the country as far as being the most accurate over the last several years. And that's actually what he had said is he thinks 3 rate cuts. He was a little bit more bullish on rate cuts, thinking that inflation will actually be coming down faster than what's anticipated. So we'll see. You know, we'll see if he's right. But more importantly, though, the prediction isn't just about what's happening this year. It's also what's happening next year, 2025, 2026, that the trend of interest rates will continue to come down as inflation comes down. And really, you think about investments that you own today, the price of stock today really is trying to anticipate what's going to be happening over the next 12, 18 months, 24 months. Really, it's future earnings really that are priced in today. So that's why when something unexpected happens, why the market doesn't like surprises like a 9/11 or something like that, you know, it kind of blows all those assumptions out of the water and questions what's going to happen to earnings going forward.
Absolutely. Yeah. And then, of course, as the rates drop, that really does tend to be a tailwind.
It does.
Right.
Yeah, for sure.
For a lot of things in the market and the economy in general.
Yeah. The real estate market should be positive for that. Should be positive for stocks. Certainly also as rates come down, for those of you who own bonds, right, if you're a little bit more conservative, you've got fixed income in your portfolio, tends to be a seesaw effect where as rates come down, the value of existing bonds actually goes up in price. So it actually could be some good tailwinds with lots of different types of investments really over the next couple of years. So depending on how aggressive or conservative you are, really there should be opportunities in any of those investment strategies.
Absolutely. And then, of course, really, when it comes to what is going to take that, you know, the market to that next level, it's kind of the same thing, right? That productivity, you know, innovation, how these companies really kind of make new things happen.
Right. Yeah. Yep. And, you know, demographics aren't going to do it for us. That's where, you know, for a while anyway, you know, in China, it was just by sheer population that they were able to grow at the pace that they did. Now they're seeing that reverse, right? As they're seeing an aging population. We've experienced that for a long time. Right. In the United States, we haven't had a high growth rate, right, as far as babies being born for quite some time. Our growth has mainly come from immigration, right? You know, from people coming here and, you know, getting jobs and so forth, driving productivity that way. But really, a lot of it does come down to technology. Again, if you look at the fact that we didn't even have smartphones in our pockets, 15 years ago, they barely existed. So now we just take it for granted. A few decades ago, the internet didn't really even exist to any large degree. Think about the productivity that's been driven and what's going to be driven as AI, robotics, other things take effect. It's actually pretty amazing. Nobody knows the exact implications, but certainly technology will continue to drive growth.
I think so as well. Yeah, just kind of continue to create that productivity, and that's ultimately what, you know, higher levels of productivity create better earnings.
Yeah, absolutely.
Right. And then, of course, things to always remember.
Yeah, this one's pretty important. We did a seminar on this a few months ago, actually. I think it was back in September. So for those of you who want to go back, it's out on the YouTube channel, but we talked about really what does it look like in the short term, implications for investors that are invested in the market, you know, and this is just looking at the S&P 500 on our slide here, but looking at short-term implications and long-term implications. Short-term, nobody knows. Clearly, there's going to be a lot of volatility in the stock market. So it's kind of like getting on an airplane. You're going to experience turbulence at some point during the flight. That's just normal, especially if you're landing in Denver, right? Almost always, you're going to have a turbulent landing. But in the long run, how many planes actually crash? Not very many. I mean, the odds are pretty darn low that there's going to be a plane crash, and certainly turbulence doesn't cause plane crashes. It just makes everybody uncomfortable. So more or less, if you've got some time horizon, that's what this is really unpacking on this slide, is that if you've got some time horizon, your odds are, we can't say guaranteed, we can never use that number, but we can say that 100% of the time, every time there's been a bear market, every time there's been a correction, 100% of the time, the market has come back and gone higher than it was before. The trick is we don't know when, right? The time frame as far as, well, how long does it come back? How long does it take until I get my money back and we go higher? Sometimes it's a long time. Like they say, the lost decade back in the 2000s, where in the year 2000, the stock market was very high. And then we saw a massive dip. The S&P dropped like 56%, something like that, from top to bottom. And it took a number of years to get anywhere close to those points. But then we ended up going into another bull market, right, in the 2010s. So these things can play out over years. But on the slide here, we're showing that there's never been a time historically, if we go back over the market history, there's never been a time where somebody would have been down on the S&P 500 over a 20-year period or beyond. Even over a 10-year period, you're 90% plus, 90% plus that you wouldn't be down over a 10-year period. And then, as we start going down, even over a 5-year period, only in 80% of the time, you'd still be positive. So none of this guarantees anything, but it does kind of give you, some reasoning behind, well, why do we invest the way that we do? A lot of it does come down to how long do you have? How long do you have until you need that money? And for those of you who are thinking, well, gosh, I'm retired, so I need it now, or I'm going to retire next year, but is it all going to be spent next year or even in 5 years, or is this over decades?
Yeah, how long is retirement? Right. It's not like you retire and all of your funds come out of the market. Right. So that's kind of the key too, is that I think a lot of us look at these numbers and they say, well, yeah, I got 5 or 10 years. I'm young. I can do this. Some of us might not. We might look at that and we'll be like, I'm going to retire next year. My time horizon is not that 5 or 10. But, if you really think about it, how long are you going to live in retirement? 20, 30, 40 years, maybe?
Right. Yeah. Right? Most people, especially if you're married, you've got another partner that between the two of you, even if one passes away earlier on, the odds of the other one living a long, life, it's extremely high. I think the odds of, like, for a married couple, I think in their 60s right now, they're saying that it's like a 90% chance that one of them will make it into their 90s. So it's really high, in other words.
Absolutely. Yeah. Yep. And then, of course, kind of going in the same way. So we were looking at the upside. What about the downside?
Yeah.
Right. How often does that happen?
Yeah. All the time.
Absolutely.
Yeah. Yeah. That's the price. I mean, effectively, that's the price of being a stock market investor, and even in other markets. If you're a real estate investor, if you're a cryptocurrency investor, if you're a bond investor, that doesn't mean that you've got a free lunch. You're still going to experience volatility in those areas as well. Even the real estate market, we think of our home prices. Yeah, almost always, they at least stay steady or they go up each year. But there have been times, like in the mid 2000s, where we saw a massive drop. And some of our clients that lived in Arizona, Vegas, some of these areas saw a 50% drop drop in the price of their house.
Absolutely. Absolutely. So the things to kind of, and I think we lose sight of this, right, of a lot of these, but that volatility is, I love that phrase, volatility is the toll we pay to invest.
Exactly.
Right? And it absolutely is true. But days like yesterday, it's kind of opportune that we have this today.
I know,
right?
Yeah, it's good.
But yesterday was a couple % dip, right? Those happen at least 7 times a year on average.
It's true.
Right? Bigger ones like that, 5%, at least 3 times, usually during the year. But I think you can, even if you're an investor and you've been doing this for a while, I'm going to bet you're probably going to be hard pressed to go back to any average year and just say, oh yeah, I remember when that.
Yeah, as far as the world event,
3%
drop. like the Greek debt crisis back in 2011. How many of you really remember that?
Yeah,
not many. I mean, I do, because this is my business, right? This is what we do. But most people don't even remember that stuff.
Yeah. Or even a 10%. So 10% being an actual correction, right? And those happen about once a year.
Yeah. So doesn't mean it's comfortable. If you've got $1 million, that means you log in and you see $900,000.
Yeah.
So not to say that it's going to feel good by any means, but that doesn't mean the plane's crashing. I think the fear, and emotionally, this is why it's important not to get sucked into it, is the fear is, well, my stuff is down to 900,000. What if it goes to 800,000? What if it goes to 500,000? What if I lose everything?
Right.
So when you get your emotions into it, that exactly is why we talked about before. The real enemy is getting sucked in and wanting to sell low and then buy high. That's exactly why most investors don't do very well.
Mm-hmm. And of course, bear market, so full 20% down.
Yeah.
Only about once every 2.5, 3 years.
Yeah,
which we felt recently.
2022, 2020, and then another one in 2022.
Yeah.
So yeah, it's unfortunately it's not predictable, but they do happen.
It'd be nice if it happened once every 3 years, like clockwork, right?
Yeah,
that we could kind of plan on.
Yeah, and I think a lot of it is just recognizing it for what it is too. But it's kind of like the pilot coming on when especially if you've got a lot of turbulence, right? Maybe things are flying all over the place. The pilot comes on. For somebody who never flies, let's say that was the first time on an airplane, they're probably panicking, right? Thinking that, we're going to crash or something like that. But the reality is for a lot of our clients have been clients for a long time, and doesn't mean it's comfortable, right? But it's something that we've kind of lived through before, and we realize that there are actually patterns that we can follow.
Absolutely. We made it through and we'll do it again. Right.
Yeah. So overall, outlook for 2024 isn't all that bad, really.
Yeah.
Knock on wood, right? We never know. The outlook for last year wasn't exactly rosy, and we ended up having a great year. But this might be a more normal year. Certainly, some of the geopolitical stuff that we're concerned about, we'll talk about in a second. But the Fed should be easing to some degree. They're probably not raising rates. I think we can say that pretty confidently. But anywhere between 1 to 3 rate decreases. Hopefully, that'll help. Economy should be slowing down. We haven't really seen that happen a ton yet, but that should be slowing down with the higher rates. So overall, the advice is kind of crucial. Stick with your advisor. If that's us, thank you. If it's not us, then you should come talk to us, right? But if you've got a great certified financial planner, that's awesome. Hopefully, they're delivering great results for you. But if you're kind of questioning that or just want a second opinion, that certainly would be welcome to have that conversation. Yeah.
Yep. And it's always good to just have that advice, even if it's just a sounding board, right? A professional that you can kind of say, hey, it is an election year and I'm worried about this or that, or do we need to adjust things? Someone that you can bounce those ideas off and kind of walk it through. I think that definitely helps.
Yeah, politics or geopolitics certainly is no. There's no less certainty right now than there was a year ago. I think we've just kind of gotten used to the fact that we've got turmoil in the Middle East. That's been the case for thousands of years, unfortunately, right? But it's not to minimize, kind of what's going on, personally or loss of life. But it's something that certainly creates uncertainty. We've kind of been through that before. For those of you who are older, I'm sure you can point to lots of times where there's been a lot of war and so forth going on there. China and Taiwan, that continues to be a fear, maybe that China comes in and strong arms Taiwan, takes it over, because the world semiconductors, most of which are manufactured there. It's a concern. Is it something that you're going to bet your entire portfolio on, it happening one way or the other? Probably not. Right. But certainly it's something that we're keeping an eye on. And then Ukraine, another area we didn't put on the slide, but it's kind of like everybody's forgotten about Ukraine and Russia, right? Everything else is jumped into the headlines, but it's still a big deal. It's kind of a stalemate at this point. It doesn't seem like either side really has made any significant push. So who knows, eventually even forest fires, even really big ones, burn themselves out and move on. That's also been an area that for centuries, right? There's been fighting back and forth with borders and taking over countries and so forth. So as disturbing as it may be, it's important to be careful about what you watch on the news too, because it's kind of like watching CNN is the crisis news network, right? And Fox, we could probably think of something for them too, right? But ultimately that's what gets. They're looking for eyeballs. They're looking for clicks, right? That's what they get paid off of. So you understand that their motivation is very different than ours. Right, we're a fiduciary. They are not. Their job is to scare you, right? And it usually works.
They want your viewership.
They do.
They count on it, right? Yeah. So overall, kind of like you were just saying, right? Anticipation of some pretty solid but not super spectacular returns. Just kind of a really average year. Things kind of normalizing after, if we really think about it, since 2020, we've had kind of some really crazy
Oh, huge
up
huge
and
things.
down.
Yeah,
Right,
absolutely.
for all of that. So I think the overall arching idea here is that it is kind of a more of a normalizing type year.
Yeah. Yep, absolutely. And we're expecting maybe an average return on the market. For the S&P 500, certainly a 7, 8, 9, 10% return would be great, especially in light of a lot of uncertainty still out there. That would not be a bad thing. Hopefully, earnings continue to improve. That definitely leads to health in the stock market, and we also hope that there continues to be more evening out of returns. That it's not just a smaller number of companies. It's pretty likely that'll happen, and sectors tend to trade off over the years. So, but yeah, we're already kind of at that level at 5,000 on the S&P 500. We've hit some highs year to date. Doesn't mean that those will stick necessarily, but the stock market as a trend, it kind of does this over time, up and down, and overall it is driven by productivity.
Absolutely.
So, but there's a lot of risks.
There are.
Yeah.
Yep. And there's always going to be risks, right? Yeah. Those risks don't go away. But really kind of the key, like we've been saying, stay the course, have a good person that you can talk to about a lot of this stuff. If you do have concerns or anything like that, please let us know. We're always here to be a sounding board for you.
Yeah, and just remember, as you're watching the news, because we know you will, just human nature, right? And even if you don't watch it, somebody else will tell you, right? Like, oh, did you see what's happened to the stock market today, or something like that?
Yeah.
Just know that is part of being an investor. It's part of being a human, right? It's that's just the story of history, that things go up and down, and even if it's not the stock market, there's a lot of other things, even just ups and downs in our lives, right? If you've lived long enough, you kind of know that that's how it works. So just understanding that we're here to guide you, so you're not having to do it alone.
Absolutely. So as we kind of come to the end of this, please remember we have that Q&A box. So if you have any final questions, now's the time to put them in there. But we'll kind of end up here on good old Charlie Munger.
Yeah.
Right.
One of the top investors of the last 50, 60, 70 years. He was kind of the co-pilot with Warren Buffett at Berkshire Hathaway.
I don't want to really say a silent partner, but you heard a lot less from Charlie than you did from Warren. Right. Yeah. But a man of pretty big stature right there, but saying, remember that reputation and integrity are your most valuable assets and can be lost in a heartbeat. I think we kind of live by that on a daily basis around here, right?
We do. And I think that's why it's so crucial to have a fiduciary, have somebody that has that kind of relationship with you, that you really trust them, and hopefully you enjoy, working with them as well, right? That's, I think, what is fun for us on a day-to-day basis. Is we enjoy working with our clients, and the relationships and the impact that we get to have. I mean, that's what kind of juices us, right? Is that the impact that we get to have on people's lives because of the decisions. Is that everything kind of comes down to decisions that get made along the way, and sometimes not making a decision. Sometimes it's not doing something that ends up actually saving you. So that's our job, to be walking right alongside you there. And certainly we welcome anybody that you send to us. Referrals are always welcome, and that's almost all of our new clients come as a result of referrals. So a lot of our growth is over the last few years actually has been by some substantial introductions that you've been making.
Yep. And largely when we say us, it's definitely not just Josh and I. I know we're the only ones that really sit in front of the camera.
See the Brady Bunch here. Yeah.
It is the Brady Bunch.
It is, I know.
So, okay, there you go. Yep. So we have a pretty good sized team here. Lots and lots. Last time we checked, it was over 100 years worth of financial industry experience.
Yeah.
Across the board here.
I count for 25 of those. Just saying. I think actually Marcy has me beat. I think she's got more years than I do.
Yeah. That's pretty amazing though, right? But just a great crew. We're all here to help out. So whenever you do work with Keystone, you work with all of these people.
Yeah, absolutely.
Right.
Yeah. And we've got great partners as well that don't show up on here, relationships with Fidelity Investments, with Charles Schwab, some the world's top financial institutions. So we get to tap into their resources as well. In addition to any other professionals that our clients work with, typically in the community, the state attorneys, CPAs. So it really is enjoyable to build out those relationships and use that to build your planning.
Absolutely.
So with that, lots of questions have come up, but I do want to make sure that anybody that didn't get a question answered, or maybe you don't want to ask in front of everybody else, just email us. We're pretty accessible between the two of us. Email addresses are easy, just josh@keystonefinancial.com. Jeremy at KeystoneFinancial.com. Our website is KeystoneFinancial.com. So it's pretty easy to find us. And for those of you who are wanting to see this again and again, right? Maybe it's a put you to sleep sort of thing, but it's going to be on the podcast. So this will be on wiserfinancialadvisor.com. You can also watch the video replays. So if you want to look at the slides again, that's a good option. Just go to KeystoneFinancial.com. And in the upper right-hand corner, we've got our social media link. So just click on the YouTube link and that'll take you right to the page. This will be posted later on. So that's a lot. We kind of threw a lot at you today, but any other questions that anybody has?
I think everybody got their chance to answer the questions during that. Thank you all for putting those out there. Those were some great questions this time around. So we appreciate it. But like Josh said, those email addresses are up there. If you do have anything, questions or anything specific to your situation that you don't want to share online, feel free to reach out to us either by phone or by email there, and we'll be happy to walk you through that.
Yeah. And as always, thank you for your business. Again, for those of you who are clients, thank you for your business, your trust. My team and I really, really enjoy working with you. So thank you for that. And certainly thank you for any referrals that you send our way. We always will take great care of them and make sure they get pointed in the right direction. Even if they don't work with us, we'll make sure that they get pointed in the right direction.
Absolutely.
Yeah. Thank you.
Yeah. Thank you all, and have a great rest of your day.
All right. Happy Valentine's Day. Take care.